You can never go wrong in your exams. So you're looking at advanced financing decision, AFD, advanced financing decision. And really, that's what we are doing today. And I would want to make reference to yesterday's question, which you had been able to do very well, advanced financing decision. Oops, sorry, 1 minute. So advanced financing decision is what you are doing. And today, ladies and gentlemen, I would want us to basically look at 2 agenda items. I will be very happy if by the end of the session, all the students in this case here will be able to understand how to calculate what we call arbitrage profits. Arbitrage profits. And then number 2, we have this concept of breakpoints. Breakpoints. If I'm able to achieve those 2, in terms of the advanced financing decisions, then I'll say that I've really achieved our today's agenda. So, and I would want us to make reference to the question that we're doing in our yesterday's class, which was this question of Papa. This question of, it was quite a simple question. This question of Papa and Kaka. December 2023 question 1B. December 2023. December 2023. Question number 1B. Specifically, I'm going to Roman 3. No. I've done number 1. I've done number 1 alone. I've not done number 2. So I've done number 1. Using Modigliani and Miller propositions in the absence of taxes, number 1, determine the cost of equity of 𝐞𝐞𝐤 Limited. So then that forces me to start this question from scratch, unfortunately, because I can't do Roman 2 without really doing Roman 1 very well. So you're told here in a study carried out by a financial analyst, the earnings before interest and tax of Papa Limited and 𝐞𝐞𝐤 Limited was found to be 10 million. Papa Limited is fully equity financed, while 𝐞𝐞𝐤 Limited is financed partly using equity and debt. The capital structure of both firms are given as follows. So additional information, both firms adopt 100% payout ratio as their dividend policy. Number 2, the cost of equity of Papa Limited is 10%. So required, using Modigliani and Miller propositions in the absence of taxes, determine the cost of equity of 𝐞𝐞𝐤 Limited. So remember, it is MM without what year? Without taxes. So MM without taxes, what are we supposed to know about MM without taxes? Without taxes, which is MM1. We are supposed to appreciate the fact that if it is MM1, ladies and gentlemen, that debt does not have any advantage. Debt will never give you any advantage. So don't think that because you have debt, then your farm value will be higher. If it is MM1, we know that value of unlevered farm will always be equal to value of what year? A levered farm. That's MM1. Let me give you some background of these concepts here. Remember, ladies and gentlemen, we as finance scholars, we shall always tell you that, hey, always ensure that you have got what year? Tax, or rather you have got loans. Because if you have got loans, then the interest here will be tax allowable. Even we as individuals, if you have a mortgage, of course, in terms of your payee, your payee will go down. The tax payable will go down because of what is the interest on mortgage. And this concept of saving because of a high interest makes a lot of sense when you look at it from the farm's perspective. A farm that has got a higher debt amounts, of course, whose managers know how to make use of what year, or rather, they are quite strategic, etc. They don't misuse their loans. Then automatically, any farm that has got debt must always have a higher farm value. But remember, that only makes sense if there are taxes, because you're talking about tax savings. So, but if there are no taxes according to Modigliani-Miller 1, then value of unlevered farm will always be value of a levered farm. Ladies and gentlemen, remember, you can't start getting cost of equity of 𝐞𝐞𝐤 without knowing the farm values. So step number 1, please give us the farm values. Give us the farm values. So remember, we have Papa. This is the question we are doing for those who have just joined us. We have Papa and we have 𝐞𝐞𝐤. If you look at that question very well, Papa is unlevered. If you look at this question very well, Papa is unlevered. If you look at the question very well, Papa is unlevered. You can see Papa has got equity market value 100 from the table given there, and then Papa does not have any debt. So Papa is unlevered here. So Papa is unlevered, doesn't have debt. Therefore, I will start by getting its value. So give me value of Papa. Give me value of Papa, which will be value of unlevered farm. Ladies and gentlemen, assuming today I was to be a very rich man, and then I say that I'm blessing Boni Getonga, I put up a fund like a trust where Boni Getonga will be getting 10 million shillings every year, indefinitely. And then you know that the cost of capital, for example, is 10%. Can somebody give me the present value of Boni's promise? How will I get Boni's promise, present value of Boni's promise, assuming that this 10 million will be given to him every year without an end in sight? Perpetuity. Perpetuity. Are you able to remember that formula? Are you able to remember that formula if it's perpetual? Perpetuity. Perpetuity. Is there somebody who is able to remember the 10 million every year, receivable every year, where n is infinity? Where n is infinity, these guys are not able to remember. These guys are not able to remember that. These guys are not able to remember that. So in this case here, the present value of Boni's amount, present value of Boni's amount will be amount divided by what here, somebody? Amount divided by R, yes, will be amount divided by R. Please listen and listen to me. The same will be applicable to the valuation of these firms. So in this case here, the same. So we shall talk over the amount here will be the profit after what year? The profit after tax. That is why they are telling you that whatever profit they are making, they are giving it out as dividends wholly. So this becomes cash flow to the shareholders of the farm. So you'll take profit after tax, and then of course you divide this by required return. So required return, if it's unlevered, the required return will be the equity holders' return alone. Remember, these farms will stay with us indefinitely, in perpetuity. But now, my good students, how do we get this part? To get this part, if you can remember, we normally talk of EBIT. EBIT minus who? Minus interest. And then to get profit after tax, in this case, we shall come under what year? Less taxation, like that. And then we divide this by what year? By cost of equity. Of course, I am aware that this examiner has told us this is MM1 without what? Without taxes. I'm aware. But I always like putting my formula like that permanently. I'm aware that this farm is unlevered, but I always want to put in this case here that interest debt, knowing very well that it shall be zero. So in this case here for Papa, do we know what the EBIT is? For Papa, do we know what the EBIT is? Do we know what the EBIT is? Is there somebody who knows what the EBIT is? The people are confused like that. EBIT is not 100 million, Esther. EBIT is earnings before interest and tax, which will be the same for both organizations. Please check again. So many students will always give me that 100. So many guys confused. We are told in this paragraph, paragraph 1 actually, in a study carried out by a financial analyst, the earnings before interest and tax of Papa and Kaka were found to be 10 million. Whatever Esther is giving me as a EBIT is equity. She's reading equity for me, 100. So in this case here, EBIT is 10 million. Do we have any interest if the farm is unlevered? You can see Papa does not have any debt. So interest here will be 0. Into 1 minus tax. This is Modigliani-Miller 1. No taxes. So tax is 0. And do we have in this case here this cost of equity of an unlevered farm? Cost of equity of Papa. Have they given me the cost of equity of Papa in note number 2? Because I'm valuing Papa. Cost of equity of Papa, they're telling me it is 10%. You see, 10% is the same as 0.1. So then are you able to give me this value of the unlevered farm? Abracadabra. Are you able to give me this value of the unlevered farm? Value of the unlevered farm. If you take here 10 minus 0 times 1, it is 10. 10 divided by 0.1, that gives me 100. 100. So then having gotten in this case here the value of unlevered farm, which is Papa, which does not have any debt. Remember, this is value of Papa. Then can somebody in this case here give me the value of Kaka? Can somebody give me the value of Kaka using MM1? Can somebody give me the value of 𝐸 using MM1? Using MM1. Thank you very much, Maggie. Maggie ananiambia mwalimu, mimi najua sana. Using MM1, hata kama ni MM2, to get value of a levered farm, I'll always, in this case here, use this. Please, there are two ways here. Value of a levered farm will always be equal to value of what here? Unlevered. This is one of the ways of visualizing this, because that is MM1. Alternatively, you can just use the general MM formula. We know that value of a levered farm, the general one, is value of unlevered, in this case here, plus T times T. If you can remember this method number 2. This is method number 2, and I like it because this one here is applicable throughout. It's applicable throughout. Value of a levered farm equals value of unlevered plus DT. So then in this case here, then what will be the value of 𝐸? What will be the value of 𝐸? Value of unlevered, which is value of papa, is 100. 𝐸, in this case here, 𝐸 has got debt. 𝐸 has got debt. Has got debt of how much? 𝐸 has got debt of how much? Somebody who is able to follow the column of 𝐸. The column of 𝐸 here, 𝐸 has got what debt? 𝐸 has got what debt? That amount of 𝐸. Nancy is giving me 50. What is the tax rate given? What is the tax rate given? What is the tax rate given in this question? When they tell us it's MM1, Modigliani and Miller without taxes, it is 0. It is 0. Then in that case, ladies and gentlemen, I'm able to see that the value of 𝐸, which is a levered farm. Remember, 𝐸 is a levered farm. 𝐸 is a levered farm. Levered means 𝐸 has got debt in it. 𝐸 has got debt in it. So in this case here, value of this 𝐸 will be exactly what here? Will be exactly 100 million. Value of 𝐸 will be exactly 100 million. So up to there, are we together, ladies and gentlemen? Which I would have easily said that value of this levered farm equals value of unlevered farm, which is what here? Which is 100 that we got there. I don't have to go through this, but myself, I'm always used to this, some of these long ways. They always assist. So up to there, Juliana is telling me, mwalimu, we are comfortable. Now, ladies and gentlemen, from there, once you've gotten value of a levered farm, please listen to me. Once you've gotten this value of a levered farm, the next thing will be for you to dissect it. You break it down into 2 components. Once you get the value of this unlevered farm, please go ahead and break the value of the levered farm into 2 components here. So we are saying here the next step, break value of levered farm, which is 𝐸, into debt and equity components, Break it down like that. Break it down like that. Break it down like that. Break it down. Break it down. And then remember that debt is ever constant. What will fluctuate when a company makes losses? What will fluctuate is equity. But debt, once you are given debt of a farm from the beginning, we shall assume it's not going to be repaid back. It's a perpetual debt. It will remain like that. So in this case here, this debt is always what here? Is always constant. Debt is always constant. So then we have here value of 𝐸. Value of 𝐸, which is levered. Ladies and gentlemen, in this case here, this value is exactly 100. So go ahead and break it down, and if possible, always have debt at the top. So break it down to debt versus equity, because debt is given. Have they given me the debt of 𝐸? Look at that column. Have they given me the debt of 𝐸? Have they given me the debt of 𝐸? They've told me it's 50, isn't it? The debt of 𝐸 is 50. The debt of 𝐸 is 50. The debt of 𝐸 is 50. But now remember that the total farm value is 100. Value of 𝐸 is 100. So then how do we get the equity? The equity will be the balancing figure. Equity will be the balancing figure, because now it will be 100 minus this. So it will be 100 minus this 50, which gives me what there? Which gives me 50. So once you get value of a levered farm, please, the next thing will be for you to break it down. Into debt and equity, and not forgetting that debt doesn't fluctuate. Equity can fluctuate. You can see, like in this question, the initial equity was 70. Are you able to see the initial equity of 𝐸? The initial equity up there was 70. Are you able to see that? the initial equity of 𝐸𝐸 was, these guys are not seeing that figure, in that column, Hilda has seen it, Esther has seen it. The initial equity was 70. The initial debt, in this case, is 50. It's debt which doesn't fluctuate. You always use debt as the benchmark to get the new value of equity. So equity, you normally compute new values. Ladies and gentlemen, after that, then go ahead and give me the weights. Go ahead and give me the weights. The weights of the levered farm. We are not so much interested in the unlevered farm because its WACC is normally fairly obvious. But the levered farm, you have to do quite a lot. So go ahead and give us the weights. Next step, give us the weights of the levered farm. Are you able to get the weights here? Levered farm, remember, is 𝐸𝐸. Remind ourselves. So then we have here the weight of debt. The weight of debt will be 50 over 100. 50 over 100. Then we have the weight of equity. I know the equity value. It's 50 over 100. 50 over 100. So then this gives me 0.5. This gives me 0.5 like that. 0.5. So weight of debt is 0.5. Weight of equity is 0.5. Now, once you reach there, start reading the questions given to you now by the examiner. Start reading the questions given to you by the examiner. You don't read the questions. In this case, when it comes to farm valuation, using these Modigliani-Miller models, first of all, go up to there. And then I'll start reading the questions given to you by the examiner. Like now, question number 1. What do they want us to do there? Question number 1, under this requirement, using Modigliani and the Miller proposition in the absence of taxes, determine the cost of equity of 𝐸𝐸 Limited. Cost of equity of 𝐸𝐸 Limited. Cost of equity of 𝐸𝐸 Limited. Alango, are we together? Alango is the one who said, Mwalimu, you are very fast. I don't know whether up to here, Alango, we are together. Please always feel free, like Alango, who tells me, Mwalimu, there you are very fast. Feel free. Because at the end of the day, we want this program to be very effective. Are we together? Are we together? It seems like Alango today is not around. But are you guys following? Are you guys following here? Are you guys following here? Are you guys able to follow? Are you guys able to follow? All right. Thank you very much. Now, ladies and gentlemen, then what I will do here, we are doing this December 2022. Sorry for rubbing it. It's December 2022. Question number 1B. So you come and write, because so many times we see students who just do questions haphazardly without telling the examiner the exact question number that they're doing. We are doing Roman 1. I must, in this case, here put a title to it. It is cost of equity of a levered farm, which is 𝐸𝐸, like that. Then I'll remember the big formula. I like this formula because it's all weather. This formula, 𝐸 equals 𝐸 equals 𝐸 plus 𝐸 minus 𝐾D into D over E. You subtract tax. This is a very important formula of getting cost of equity of 𝐸𝐸, which is cost of equity of a levered farm. So remember, 𝐸 is cost of equity of unlevered. Unlevered farm to us is papa. Is there somebody who is able to remember the cost of equity of papa? 𝐸 is cost of equity unlevered. And the unlevered farm we have here is papa. It is 10%. Hilda is reminding us. It is 10%, isn't it? So this is 10%. 10% plus 𝐸 is still 10%. So do we have any debt instrument? If yes, do we know the interest of that debt instrument? Do you know the interest of that debt instrument? They're telling me it is 5%, isn't it? They're telling me it's 5%. KD is cost of debt, 5%. Multiplied by the debt over equity. It's either you use the debt stroke equity for 𝐸𝐸 that you had obtained up there, or even the weights are still fine. You can use weight of debt, weight of equity, or a debt amount over equity amount. Remember, we are evaluating the cost of 𝐸𝐸. And the 𝐸𝐸's debt, if you remember very well, 𝐸𝐸's debt was 50, its equity was 50. Into 1 minus tax, still we are talking about Modigliani-Miller 1, whose tax is what here? Whose tax is 0. Whose tax is 0. So then are you able to give me the cost of equity of 𝐸𝐸? Cost of equity of 𝐸𝐸, which will end up giving us what figure? Cost of equity of 𝐸𝐸. According to Esther, Hilda, I'm getting answers from the same students. I mean, I would wish to get students from, these things from everybody. Everybody has to talk to me. Naomi has given me 15%. 15%, because you see, bracket, this is 5%. Of course, this will be 1 times 1 again. So 5% plus 10% body mass. So I'm getting at the end of the day, what percentage there? 15%. This is a very important formula that must be mastered by everybody in this class. That must be mastered by everybody in this class. So then we go to Roman 2. We go to Roman 2. So Roman 2, what do we have there? So Roman 1, down. So now we go to Roman 2. We go to Roman 2. So Roman 2, what are they telling us there? Roman 2, they want us to comment on the equilibrium position on the value of both firms, and hence show that the capital structure will have no effect on both value of the firms and the WACC. This is very easy. This is very easy. I've got 2 firms. I've got 2 firms. Normally, I'll do a table here. To show the examiner, I'll do a table here. A table to show the examiner that there is no impact of debt in our firm valuation. I will do a table. So I have my firms. So I have, in this case here, Papa. I have Kaka. So I have firm value. Then I have WACC that I have to compute. So are you able to see the firm values of Papa and Kaka? Is there somebody who is able to tell us what the firm values are? Anybody who is able to tell us what the firm values are? Firm values of Papa and the firm values of Kaka. It's 100, 100. We've already done it, isn't it? It's 100, 100. Thank you so much. 100, 100. Remember, Papa is unlevered. Don't forget this. Papa is unlevered. Kaka is levered. Kaka is levered. So there is this one concept that you must always remember about, and it's a free mark, really. It's a free mark, really. That always washu equals KU. Washu equals KU. Washu equals KU. Meaning that WACC of unlevered firm will always be equal to cost of equity of unlevered firm. Do we have cost of equity of Papa in this question? Note number 2. Are you able to see the cost of equity of Papa? Cost of equity of Papa is 10%. So Washu equals KU. So at least this one here we know is 10%. So, and remember, our unlevered firm is Papa. And then this WACC of Papa will be 10%. Like that. Iya inanga maneno. Mahali kuna kadiambo kidogo ni hapa. Mahali kuna kadiambo kidogo ni hapa. Na nikiwa mimi ni student, hata nikichanganyikiwa, what value should I write here? Hata nikichanganyikiwa? Because the moment I have this table, I have all the marks. Hata nikichanganyikiwa in this question mark, what percentage do you think should I put there? I mean, when there are no taxes, we expect things to be at equilibrium. When there are no taxes, we expect things to be at equilibrium. Hebu niambie niweke percentage gani hapa? Nataka kuona wanafunzi wangu hapa, niambie. Hapa mahali nimeweka question mark. Nitaweka 10%. 10%. Hapa nafaa niweke 10% as well. Because without taxes, you will not have a cost of capital advantage. You will not have, in this case here, what here? Any firm valuation advantage. Simply because you've got debt. Whether you've got debt, the firm values will be the same, and the WACCs will be the same. That's how you show equilibrium. But for us, because we are studying here, then we have to calculate this WACC of the levered firm. So mention there very fast. You have used there 1 minus T, there are no taxes. 1 minus T, there are no taxes. You know, even if there are no taxes, how I prefer it, when they tell me there are no taxes, then I'll say 1 minus 0. I always prefer it like that. So that I can have, in this case here, formulas that flow from the net income approach, net operating income approach, Modigliani-Miller propositions from 1 up to 4. I like putting that T there. So that everything can flow. All right. So then let's calculate this WACC. We calculate this WACC for the levered firm. WACC for the levered firm. How do we get this WACC? WACC for the levered firm. So WACC for the levered firm, which is WACC of L, firm L. This WACC for firm L will be Wekesa plus, in this case here, WD, KD into 1 minus. I know tax is not there, my friend, but I'll just put it there because I'll put there 0. I'll put there 0. So ladies and gentlemen, are you able to remind us what these weights are? Remember here, you use scale. You shall use scale there, not just any cost of equity, because you are evaluating a cost of equity or rather WACC of a levered firm. So is there someone who is able to remind us what these weights were? Anybody who is able to remind us what these weights were? Abracadabra, these guys are not talking to me as usual. So in this case here, the weight of equity, they are telling me it is 0.5 times 𝐻. 𝐻 is the one that they calculated above, which was 15%, plus 0.5 multiplied by KD. I'm so sure somebody will tell me that they don't know what KD is. I'm 100% sure that people will tell me that they don't know what KD is. KD is 5%. Cost of debt instrument given there is 5%. So 5%. My friend, look at this. Even if I'm putting this T, I mean, it's nothing. I know T is 0. I'll not break anybody's bone. I want to break anybody's bone. So in this case, ladies and gentlemen, you can see here that you're talking about what here. Are you able to get that 10%? Are we able to get that 10%, all of us? Because this will be 7.5. This will be 2.5. If I add both, I'll end up getting 10%. Then, of course, our comment there will be that with or without debt, the WACC of both firms are the same. With or without debt, the WACC of both firms are the same. Another dash. With or without debt, the firm values are the same. With or without debt, the firm values are the same at 100. The firm values are the same at 100. With or without debt, the WACCs are the same at 10%. And therefore, debt is irrelevant. And therefore, debt is irrelevant. And therefore, debt is irrelevant. Walimu, could you please calculate 𝐻, the 10%, using the formula? Which 𝐻 10% using the formula? I know there is another formula, Joyce. But I would really, really wish if you can just adopt this formula. I know why. The other formula is not applicable in some situations. This formula of 𝐻, Joyce, this is very good here. 𝐻 plus 𝐻. Imagine a cram to see ngumu. It's applicable all weather. And I'll be able to show you so many questions from your past papers till you appreciate why you guys should be able to cram this. Comment. I've already commented Frida. I know Frida is looking for a very strong comment. A very strong comment. Frida, what have we said? Frida, what have we said? Let me write down. Let me write down on the comment. Under that table that you have made up there, is that with or without debt. With or without debt, the firm values are the same at Kenya shillings 100 million. At Kenya shillings 100 million, if you wish to return those millions. That's dash number 1. Dash number 2 is with or without debt. Yani ukuwe na debt ama usikuwe nayo. With or without debt, the firms WACC, are what here? The same at 10%. And therefore, debt is irrelevant. That's what was discovered by MM1. In the absence of taxes, whether you have debt or not, the firm value remain the same. You will not have what we call a cost advantage. All right. Thank you very much. So can I rub this very fast? Can I rub now this very fast? We move on. At least you have an idea now. The thing here is having an idea. Can I move on? All right. So then we go to what I wanted us to discuss today. What we are calling what here, ladies and gentlemen? Arbitrage. So remember, arbitrage profits are risk-free profits. Arbitrage profits are risk-free profits. These are risk-free profits, i.e. investors investors exploit price stroke value differentials of products in different markets to make quick profits here, to make quick profits. So whenever we talk of arbitrage profits, these are risk-free profits here, i.e. investors exploit price stroke value differentials of products in different markets to make quick what here? To make quick profits. For example, I come from Kisii. There are days when Kisii bananas used to be very cheap. I don't know what happened over there of late. Bananas have become very expensive. There are days we would get like a whole bunch of banana harvested at 100 or even at 60 shillings. And then you could take the same banana, for example, in this case here, to a different market, say in Nairobi or Mombasa, and you get like 500 for that whole bunch like that. So if you're able to move your goods from one locality to another locality, and then you exploit what we are calling price what are differentials, then automatically you'll be able to make what we call an arbitrage profit. We can also do the same whenever we talk of foreign exchange. Whenever we talk of foreign exchange, foreign currency, you can move a foreign currency from here, one bureau to another bureau, and then of course that price differential, if you exploit it very well, you'll be able to make a profit. So like now in terms of firm valuation, you will realize you're an investor who has shares in Safaricom. If you just go and sell your shareholding at Safaricom, get cash, and then you transfer that money to a different organization. By making that transfer, you make some profit in between, then that profit will be called what here? Arbitrage. So you are exploiting price differentials of commodities, price differentials of values of farms, etc. to make what here? Profit by moving around, by moving your investment around. So like now, Roman 3 of this question, we are told Roman 3, calculate the arbitrage profit, if any, for a shareholder holding 10% of the shares of 𝐶𝐤𝐤 Limited. Sorry, Frida, of 𝐶𝐤𝐤 Limited. So they want us to calculate the arbitrage profit, if any, for a shareholder holding 10% of shares of 𝐶𝐤𝐤 Limited. Frida, can I rub this, Frida, now? Can I rub this? Somebody can easily post even this on WhatsApp. All right, thank you very much. So then what we ask ourselves is, how much is this person, a low-hanging mark, how much is this person earning from 𝐶𝐤𝐤 today? The investors' earnings, that's dividends. Dividends from who? From 𝐶𝐤𝐤 today. From 𝐶𝐤𝐤 today. So remember, how do we get in this case here his dividends? It will be his shareholding times profit after tax. So basically this will be 10% times EBIT minus interest, which gives you EBT after umetoa interest, and then of course into 1 minus tax like that. This is a free mark really. 10%. Remember currently, we are told currently he has 10% of 𝐶𝐤𝐤's shares. That's what they have told us. If you look at this very well, they have told us there that calculate arbitrage profit, if any, for a shareholder holding 10% of the shares of 𝐶𝐤𝐤. So abracadabra, are you able to see the EBIT of 𝐶𝐤𝐤? Is there somebody who is able to see the EBIT of 𝐶𝐤𝐤? Is there anybody who is able to see the EBIT of 𝐶𝐤𝐤? EBIT of 𝐶𝐤𝐤. Are you able to see the EBIT of 𝐶𝐤𝐤? It is 10 million, isn't it? So we have here 10. So we have here 10% into bracket here 10 minus. How about interest? Interest. Let me see whether there is any ninja who will be able to get this interest. Let me see whether there is any ninja who will be able to get this interest. Interest. They have a 50 million loan. A 50 million loan, and the rate of interest is 5%. So 5% of 50 million into 1 minus tax is 0. Into 1 minus tax is 0. Into 1 minus tax, which is 0. So currently, this gentleman is getting how much? In form of dividends. in the form of dividends is getting 2.5 million. I would rather we leave out the millions, I would rather we leave out the millions so they don't confuse us. So currently, this gentleman is getting 2.5. These are free mark. Free mark. Currently is getting 2.5 million. Currently, Kaka. So what if he shifts to this other new company now called Papa? If he was to shift to the new company called Papa, what will happen? What will happen? Nancy is saying 0.75. I don't know how she got 0.75. I don't know how she got 0.75. Who is telling me the truth? What is the final answer, somebody? I just want the final answer. I want the final answer here. C2 is getting 0.75. It seems 0.75 is the correct answer. I want the final answer. So this gentleman is getting 0.75. Thank you very much for standing your ground. Please let us correct this figure and ensure that all of us are correct. So you're getting 0.75 there. Is that okay? Thank you so much. Thank you so much. Now, from there, ladies and gentlemen, we shall be able to do what here to look at the divestment. Look at the divestment. So now we know what is earning currently. So divestment. So divestment. Divestment. The opposite of investment. So in this case here, remember he has 10%. 10% of Kaka. 10% of Kaka. So please give me the capital structure of Kaka. Capital structure of Kaka. Capital structure of Kaka. Are you able to see in this case here the current equity? How much equity does it have? 70. 70. Current capital structure of Kaka. Of Kaka. 70. How about the current debt? Current debt. Current debt. In this case here, 50. Current debt is 50. So now we want to divest here. Remember, he has 10% of equity. So the first thing that he will do is to sell his shares in Kaka. So he sells his shares in Kaka. So how much will he get? Will he get 10%? Because he has 10%. He owns 10%. So he sells his shares in Kaka. He's divesting now. He sells his shares in Kaka. How much will he get? Somebody please try to participate here. So Nancy tells me that this gentleman gets 7. Gets 7. And then, ladies and gentlemen, this is an assumption. So 7, sorry. This is an assumption here. An assumption. Remember, this person ameonja utamu ya debt. Yeye amekuwa akiinvest kwa kampuni ziko na debt. Na Papa haina debt. So he would want to leverage more on debt to be able to buy a bigger stake in Papa. So an assumption here. So this is an assumption here. This is an assumption, very important assumption. Assumption, because he wants to mirror the debt structure, the capital structure of Kaka. So assumption is that he sells bonds in Kaka. So in this case here, basically, he is able to go and borrow outside there an amount that is equivalent to his percentage, his 10% of Kaka's debt. So Kaka's debt is 50, and of course this guy is only working with his percentage. He's only working with his percentage. So he shall be able to go to, he just wants to mirror the capital structure of who, of where he's coming from. But of course, as per his percentage. So basically, you will go to the capital structure here, you multiply this with 10%, and then you multiply this with 10% like that. So then, ladies and gentlemen, here, 50 times 10%, we are able to get 5. We are able to get 5. So remember, this is an assumption because of mirror. He wants to mirror the capital structure of Kaka. So then when he does this divestment and borrowing, how much shall he be having in total? How much shall he be having in total? He has been able to sell his shares and he has been able to sell bonds. When you sell bonds, you're borrowing. You're borrowing. So how much shall he have in total? It is 7 plus 5. So in this case here, the amount he has in total will be 12. The amount he has in total will be 12. Will be 12. Aya, so sasa tuanze kazi hapa sasa. Tuanze kazi hapa sasa. So in this case, he has been able to divest and he has been able to borrow. So in total, he is working to Papa with 12 shillings, 12 million. He has 12 million. So in this case, then what percentage of papa will he buy? Percentage of papa boat. Percentage of papa boat. Percentage of papa boat. So percentage of papa boat. Remember, this gentleman has gone with 12 shillings to buy papa's equity. To buy papa's equity. Is there somebody who is able to tell me the amount of papa's equity? Are you able to see papa's equity? Go to the papa's equity statement. Papa's equity. How much in this case here does papa have in form of equity? It's 100, isn't it? It's 100. So then in this case here, the percentage here will be 12 over 100, which will be the same as 0.12. So this gentleman will own 12% of papa. Will own 12% of papa. Will own 12% of papa. And then how much dividends will he get? How much dividends will he get? So look for dividends in papa. So dividends in papa. Dividends in papa. Dividends in papa. So remember, to get dividends, you take his shareholding into EBIT minus interest into 1 minus tax, because we're looking at dividends being paid out of PAT, out of profits after tax. Out of profits after tax. So dividends in papa. So dividends in papa, ladies and gentlemen, this will be 12%. Do we know papa's EBIT? Do we know papa's EBIT? Do we know papa's EBIT? Now they're not talking to me. Papa's EBIT is the same as EBIT of what, Yakaka? 10. Do we know the interest amount that will be paid? Do we know the interest amount that will be paid by papa? Do we know the interest amount that will be paid by papa? It is 0 because papa is unlevered. Papa does not have any interest. So it is 0 here. It is 0 here. It is 0 here. It is 0 here. Into 1 minus tax, tax is 0. Into 1 minus tax which is 0. So at the end of the day, in this case, this gentleman will get what dividends? Will get what dividends? Will get what dividends? Naomi is giving me a figure of 1. Leonid is giving me a figure of 1.2. But now remember, there is something in this case that he has to remember to deduct here. Do you remember? Do you know what he has to deduct out of that dividend? For him to be able to get a bigger shareholding, he did something. There is an interest on personal loan. Interest, so less interest on personal loan. Less interest on personal loan. He took some amount. He took some amount in form of a personal loan. He took some amount in form of a personal. Are you able to remember that amount? Are you able to remember that amount? Are you able to remember that amount? It was 7 plus a debt of 5. Yes, there's a debt of 5 million. He took a debt of 5 million. So there is a debt of 5 million. And remember, he shall get access to these loans at the same rate that corporates are getting. At the same rate that corporates are getting. And there is a corporate here called 𝐁𝐥𝐞𝐤 whose loan was at 5%. The rate of interest is 5%. So 5 times 5%. Quite tricky, but it's something to get used to. So 5 times 5%, what are we getting here, ladies and gentlemen? 5 times 5%. So I'm being given by Nancy here 0.25. So you subtract this out of 1.2. So how much? How much? How much will you get net of the interest? Net of the interest, sorry. Net of the interest. Net of the interest. How much will you get? 0.95, isn't it? So he gets here 0.95. 0.95. 0.95 is what he shall get. So now compare the net amounts. How much, if he was to stay in 𝐁𝐥𝐞𝐤, how much would have he gotten? If he goes in this case here to papa, he's getting 0.95. All right. So the net benefit. The net benefit. Is there somebody who is able to compute the net benefit? Is there somebody who is able to compute the net benefit here? Net benefit of going to papa. Net benefit of going to papa. Net benefit of going to papa. Net benefit. Net benefit of going to Papa. So in this case here, number one, we have net dividends from Papa. Net dividends from Papa of 0.95. And then of course we had dividends from Kaka. Dividends from Kaka. Kaka alikuwa anapata ngapi? Kaka alikuwa anapata ngapi? Kaka alikuwa anapata ngapi? Kaka alikuwa anapata ngapi? 0.75. Kaka alikuwa anapata 0.75. So this gives me 0.2 as a net benefit. As a net benefit, which in this case here will be what here? Which in this case here will be the arbitrage profit. They're quite a tricky working, but trust you me, if you take some time later on and have a keen look at it, it is something you can follow. It is something that you guys can easily follow. And even if you don't get all the marks, there are very many low-hanging fruits there. There are very many low-hanging fruits there. I know the only area that confuses my students here is this area of divestment. Once you understand that section of divestment, then you have understood the entire thing. You'll end up getting so many marks. Like myself, what I'll do, I'll simply go to that capital structure. It is 70 and 50. So if he has 10% shareholding, I'll say 10 times 70, 7. 10 times 50, 5. So I have 12 is the total amount. So once I get 12 as the total amount, then I'll be able to run it through. I'll only miss out one mark, which is what here somebody, the concept of the interest on the personal loan, that one alone. But otherwise, I'll be able to get most of the marks. So do you think, ladies and gentlemen, that now this is a challenge I can leave for you? You guys go and look at this concept very well later. Do you think it's a challenge I can leave it for you now? At least you have some high-level understanding. You have some high-level understanding. High-level understanding. You don't have to get like everything. First, you mean Kenya, arbitrage profit. Most candidates will get like 0. But if you have some idea, that methodology, you'll be able to get so many marks without knowing what you're doing. Without knowing what you're doing. If you allow Mwalimu, then, ladies and gentlemen, very fast, I would want us to look at pretty fast. I would want us to look at the September 2021 question 4B. September 2021 question number 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 4B. Breakpoints. September 2021. September 2021 question number 4B. After I'm through with this particular topic, ladies and gentlemen, my next topic, which is very critical, is called advanced capital budgeting. Those decision trees, simple things, but they really give students, in this case here, a problem. And I know the areas to touch. Unfortunately, we have been able to do that topic with Mwalimu Kashero. So mine basically is to come and do what here, just to tie any loose ends. And then all of us will be very comfortable, like now what you're doing here. What you're doing here. And that is why I don't want, is there any student who is doing this special revision class who is not in our normal class? You are doing special revision and you're not in our normal class. Do we have such students here? Do we have them here? You are doing this SPR and you are not in our normal classes. Do we have them here? Please don't fear. Do we have anybody like that here who is not in our normal class and then they are doing this special revision? Like Terry, 1, or Lizzie Nyanjui, yes. But then, okay, I'm so sure there are not only 2, but then we are making an assumption that you guys have ever attended an AFM class somewhere. Because truth be said, if you're attending this session, and this happens to be the only class you're attending of AFM, and you've never done this course elsewhere, you will really be disadvantaged. Because here there is nothing like definitions. It's just special revision. Actually, special revision program, let me be very honest with you. This program is supposed to be meant for people who have ever attempted CIFA exams and failed. That's how it was in those old days, special revision for students who have ever attempted and failed. And then, of course, we don't teach like the entire thing. Students will come and tell you, Mwalimu, we only have a problem with this and this and this and this. Actually, like in the next chapter, I would expect you guys to tell me like that, Mwalimu, we know that you have areas that you want to teach us. teach us your areas, and on top of that, do this and this and these questions for us. Because that is what special revision is supposed to be. So Lizzie and the other colleague that I've seen here, you have some task there then. I hope you have done this paper before. We shall overcome. So September 2021, question 4B. Have we gotten this question? 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 Abracadabra. Thank you so much. So always read the requirement. So the requirement that they want us to calculate the breakpoint in the marginal cost of capital schedule. So they want us to calculate the breakpoints. Breakpoints in the WMCC schedule. Weighted marginal cost of capital schedule. So remember, just by definition, general definition, breakpoint is that point at which our cost of capital increases or changes. So breakpoint is the point at which the cost of capital changes, stroke increases. We should talk of increasing. Breakpoint. So if, for example, you have your cost of capital moving like this, that point at which, ladies and gentlemen, where we have a break, we are borrowing in this case here, for example, equity at 10%. And then in this case, it goes to 12, it becomes a bit expensive. Then this point here is what we call the break point, the point at which, ladies and gentlemen, our cost of capital, or where our marginal cost of capital, in this case here, changes. We call this one here the marginal, this one here, because it's very tiny, very, very small, marginal cost of capital. And how do we get breakpoints? Remember, breakpoints, we normally calculate the breakpoints for each item in the capital structure. Like now here, in this question, Dynasoft Limited capital structure, which it considers optimal, is given as follows. We have debenture capital 25, we have reserves, we have ordinary share capital, we have preference share capital. There is a point where the examiner wants to catch you up, but they can't catch my students there. So this is how my capital structure looks like. So I have debentures. So debentures, we have 25. Debentures, we have 25. We have equity. So equity, of course, I will combine reserves belong to equity holders. So I'll take reserves plus who? Reserves plus who? Reserves plus ordinary share capital. I combine them. So I will take 15 plus 45, which gives me 60 there. Reserves. If we had retained the earnings, I would have also combined to get equity. Equity reserves belong to equity holders. And then we have preference share capital. We have preference share capital. Preference share capital, ladies and gentlemen, in this case here is 15. So can you kindly then give me the total? Please give me the total. It will still be 100, isn't it? It will still be 100. The total here will be still 100. William alone, 100. 100. Fortunately, these figures that you are seeing here, they're the ones considered optimal capital structure. If I'm the one setting your exams, I will tell you these are book values. When I tell you they are book values, what do you do to change them to market values? When I tell you that these figures are book values, what do you do to change them to market values, optimal values? What do you do? What do you do? If you're told they're book values, what will you do? Because if I'm the one setting, I have to complicate something, because I don't want anybody to catwalk after their CASNEB paper. Nobody should catwalk. Hiyo siku hata kama uko na high heeled shoes, tunataka uzitoe, uvae raba, mama, utembee polepo, hata makeup ina toka yote. We shall overcome. We shall overcome. We shall overcome, but they are not my friends. When you are told that these figures are book values, you normally, if they were book values, normally you divide them by the par value, and multiply this by the market price. I'll be able to touch on this because I can see you have an small issue there. When they are book, I'll be able to touch on that. But now, fortunately, here I'll be able to get my weights very fast. I'll be able to get my weights. So this will be 25 divided by 100 gives me 0.25. This will be 60 divided by 100 giving me 0.6. This will be 15 divided by 100 giving me 0.15. The weights must always add up to 1. So, ladies and gentlemen, up to here, are we together? I can see Leonida has written something there. I can see Leonida has written something there. All right. divided by, Leslie. Thank you very much. Leslie is becoming a very good lady nowadays. Very good lady. Thank you so much. And then, ladies and gentlemen, what we shall do to get this breakpoint, let's start with the breakpoint of equity. It's the easiest. Breakpoint of equity. Breakpoint of equity. So how do we get this breakpoint of equity? We shall start with the amount available in retain. So first of all, read the formula, breakpoint equity. So breakpoint equity, we shall take the amount available, maximum amount available, maximum equity amount available, equity amount available, all over, in this case here, cost of weight of equity, sorry, all over weight of equity. And then, of course, the very first thing that I know is that I'm going to have the first breakpoint being the amount we shall get from retained earnings. Retained earnings normally is the very best source of equity, cheapest source of equity. So breakpoint. So are you able to see the retained earnings here, ladies and gentlemen? We are told in note number 3. We are told there, the company's expected net income for the year, that's profit after tax, for the year is ending 31st December 2020 is 40 million. Dynasoft Limited adopts a constant payout ratio of 40% as its dividends policy. So they're going to pay 40%. When they pay 40%, what will be the retained amount? What is the retained percentage? If the payout is 40%, then they're going to retain 60%. So then in this case, the maximum amount I'll have out of this vehicle will be 60% of 40 million. Come and divide this by the weight of equity. Are you able to see the weight of equity? 0.6. Thank you very much, Matunda. 0.6. So then are you able to give me the final first breakpoint there? The first breakpoint of equity. First breakpoint of equity. Nancy is giving me a figure. Hilda is also giving me 40. So this 40 is very correct. 40 is very correct. 40, you can write 40 million or 40. That's good enough. Ladies and gentlemen, after that, I know that there is a free mark really. After retained earnings, now we go to issuance of ordinary share capital and equity. So now we're looking at issuance, a new issue of ordinary share capital. So you mentioned there, breakpoint 2, under equity. Breakpoint 2 under equity. We are still looking at equity. Breakpoint 2. So breakpoint 2 under equity, after retained earnings, now we talk about ordinary shares. So you go to any information talking about new issue of shares, which is note number 4. You can see equity capital. Utilize all available retained earnings for the year ended 31st December 2020. Any extra external equity will be raised through the issue of new ordinary shares at a flotation cost of 10% of the issue price. Good language, very good language. Remember here, we are talking about maximum equity amount available all over weight of equity. They're giving us very good language. But out of these ordinary shares, have they given us like a cap amount? Have they told us that this is the amount that you can raise from these shares? Have they told us that this is the amount you can raise from the shares? No. They've only given us the flotation percentage. They have not told us that this is the maximum amount. So for those of you who looked at some cinemas some time back, there is a movie I watched. You got to say, no retreat, no surrender. No retreat, no surrender. So in this particular case, there is no amount. So maximum amount is not given. Maximum ordinary share capital amount. Amount is not given. And therefore, there is no breakpoint. There's no breakpoint. You just write like that and you get a mark. No breakpoint. So in this case, your maximum equity amount, of course, is like infinity. I mean, there is nothing given there. No maximum has been given. So after that, ladies and gentlemen, if you allow me, I will go to, do we have time really? No, we don't have time. Thank you so much. I hope you guys have enjoyed the session, and I hope you'll be able to bring more students into this program. This program is a very, very good program. Very good program. You'll be surprised. A humble request. On the same, is it possible for consideration? I don't understand, Timothy, what you are saying here. Timothy, you have my WhatsApp number. Timothy, reach out to me on WhatsApp. Thank you, bye. Thank you so much. Great, great, great. Bye.